Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host, David Kaufman. He's the president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we're looking at investing using options and how they can boost returns and mitigate risks. Joining us for a closer look at these strategies and how they work is Ken McCord. He's the president of Horizons Exchange Traded Funds. Great to see you, Ken.
Thanks, Mark. Nice to be back. David, good to see you.
Let's start with a little options 101. Just give us the basics.
Well, options are contracts between two parties, and a contract allows one party to buy an asset or sell an asset at a predetermined price on a predetermined date. It's an option. It's not an obligation. So the buyer of that option will decide whether it's in their favor to do so by the end of the term. An option to buy an asset, a stock or a commodity, is called a call option, because if I own the call option, I can call that stock away from the person who owns it. And the option to sell is called a put.
Well, there you go.
Pretty simple stuff. Well, it's not simple, but the definition
on
is.
each side of the transaction, you have the buyer and the seller. And so that you can, whether it's puts or calls, you can be the buyer or the seller. And I'm interested in understanding, to set up for what we have to talk later in the show, is how you can construct yield. So how do you get the yield out of options trading?
The simplest way to get yield is, and when we talk about yield, we're talking about income or cash flow. How do I earn money in my hands through options? And the way you do that is by selling an option. If I sell a put or I sell a call, I'm going to get what's called premium. That's the income coming in. And that I could consider yield or income.
Let's assume that I don't have any equity portfolio at all, that I'm just entering the options market. Talk about what the upside and downside are between selling options and buying options, whether they be puts or calls.
Okay, so I'm buying a call primarily based on the idea that I want to put a little deposit down or an amount down in the hopes that the stock is going to go up dramatically. And I can capture a lot of that upside for a little bit of money down. Buying a put, on the other hand, is no different than buying insurance on my car. I pay a little bit of money. If my car gets in a wreck, an insurance company is obligated to buy that wreck off of me for a predetermined price. That's buying a put, buying a call. In terms of selling a call, I'm giving someone else the option to buy something from me, and I'm obligated to sell it to them if they exercise their option. In terms of selling a put, again, I am selling insurance. I am the insurance company selling automobile insurance in that case. So those are the four scenarios. You're buying a put, buying a call, or you're selling, also known as writing. Selling is called writing, writing a put, writing a call.
Now, if you had a Nobel Prize, you might be able to explain exactly how you price options, but give it to us simply. How does volatility play in the premium that you receive when you sell an option?
So options are priced off a number of things. What we call the strike price, which was the pre-agreed upon price at which the exchange of asset will happen. The term, the biggest influence, that would be the volatility of that asset. The higher the volatility of that asset, the higher the price of the option is going to be. So if we look at a low volatility stock like BCE, an option on BCE would have a lower value to it than an option on RIM, because RIM is a much more volatile stock. Those options are going to cost more.
And that volatility, just to be clear, that can be way up or way down. It's not just volatility in one direction.
I mean, we could think about RIM as being a high volatile stock, but RIM itself becomes more and less volatile sometimes. So if RIM goes in a steady decline or a steady state up, the option will be valued less than when RIM's in a really dramatic volatile state.
Gotcha.
Ken, I think one thing investors really want to know right now, if they don't know already, is how to protect themselves on the downside, considering all the volatility we've seen lately. What are some of the best ways to do that? You touched on puts there.
Yeah, protecting on the downside. Well, there's two things you could do. You can buy outright insurance, which I talked about, the way we buy insurance on an automobile. You can buy insurance on your stock or your portfolio by buying a put. And that establishes a floor on the value of my position. If I bought RIM, I'm worried about it going down dramatically, I can buy a put on RIM, which allows me to put the stock or sell the stock to someone else. It's my option to do that. I can make that happen. And that establishes a floor value for RIM. If I bought RIM at $25, I could buy a $20 put And if RIM went below 20, I can force someone else to buy it from me for 20. So I've established a floor. That's pure insurance. That's pretty expensive to buy that insurance, but it is there. The other way to protect your downside to some degree is to write a call option on a stock you own. Now that doesn't, it just offsets your losses. It doesn't create a floor or it doesn't provide insurance. But if I sold a call on RIM, if I bought RIM for 25 bucks and sold a call option to someone else, and I received $1 for that, wherever RIM goes down and I experience a loss, I'm actually going to still get that $1 in my pocket. So my losses are offset by the amount I received by selling that call.
All right, very good. Nicely explained, Ken. We'll come back right after this, and we'll talk about using puts and calls to increase yield and offset risk in your portfolio. Welcome back to Alternative Investing. I'm here with David Kaufman, the president of Westcourt Capital. This week, the topic is how to use options to boost your investments and mitigate downside risks with options as well. And back with us for a look at all of this and strategies as well is Ken McCord. He's the president of Horizons Exchange Traded Funds. So, Ken, let's keep this rolling, and maybe you can discuss equity markets and fixed income markets and what investors are experiencing right now in terms of volatility and in terms of yield or lack thereof in their fixed income portfolio.
Well, it's amazing to see from my perspective. There's this insatiable appetite for yield out there right now. And a lot of it's got to do with demographics. People are aging and they're getting less risk tolerant and they don't know what to do. Interest rates are zero. Doesn't look like they're going to go up anytime soon. No. So they're not getting any yield on their cash. They're not getting any yield on bonds right now because, bond yields are so low. Bond prices have gone up dramatically, and that game could be over soon. So a lot of investors are looking to their stocks. Maybe I'll get yield from stocks. And yeah, you can get some dividend yield from that. But we've seen over the last 20 days, owning stocks is a really volatile game and can be very dangerous. So the better strategy, in our opinion, if you're looking for yield and you want to mitigate some of that risk or reduce your volatility, is to buy stock and then write call options on your stock position to generate more income and reduce your volatility.
And we're going to get there in a minute when we talk about that strategy. But first, I want to talk about it for those people that right now are long. And to return to what we were talking about before the break, let's talk about portfolio insurance. And I want you to explain exactly how that's going to work. That I have this portfolio, I'm all long right now, and at the very least, I want to have what you call the floor, because I'm terrified of what's going to happen to my portfolio if there's a precipitous decline in the markets. So walk me through that again, just to explain exactly the order of operations.
Okay, so I own a basket of stocks. I'm a little worried about the markets. I want to establish a floor value. I could buy a put option on the whole market, which will act a lot like my basket of stocks, obviously. And I'm going to have to pay money to buy that put option. And it's somewhat expensive. No, the same way car insurance is expensive in our opinion, until, of course, we get in that car wreck. So a lot of people think portfolio insurance might be expensive. But when you have the kind of correction we've had in the last 20 days, it proves its merit, right? So if the stocks go down and the market goes down, I can then put my stocks to someone else, whoever sold that option to me. And that allows me to insure my portfolio.
And let's take this insurance analogy one step further. Of course, you pay lower premiums on insurance when you have a higher deductible. So am I right in saying that if I'm willing to take the first 10% of the reduction on my shoulders, I can go deeper out of the money, pay a smaller premium if I'm willing to shoulder the first part of the loss? It's less expensive insurance?
Yep. So let's pretend I've just got a portfolio of one stock. It's at 50 bucks. If I want to buy a put option that allows me to sell that stock at 50, that's going to be really expensive because that means I get no loss. I'm kind of locking in. If I'm willing to take a $10 loss and I buy a put that allows me to sell the stock for 40, meaning I'm maximizing a $10 loss and no more than that, it's going to be cheaper for me to do that, to buy that put option. So yeah, you have to just decide how much you're willing to lose, how much you want to pay in insurance. And
Ken, are there other examples of if investors want to capture some upside to the market, but also protect themselves on the downside?
Yeah, I mean, there's things called a collar, which is a little more exotic, but I just said that buying puts on your portfolio can be expensive, so maybe we can offset that. So one of the strategies one could do is buy the stock for 50 bucks. I can write a call on that stock, which would cap my upside. And let's say I wrote a call, a $55 call, that caps my upside at 55. But by writing that call, I got some premium in, I got some cash. I can use some of that cash to go out now and buy insurance on my stock. And maybe I buy a put with that, a $40 put that allows me to cap my loss at $10 in that case. That would be what we would call a collar and pretty effective strategy.
Right. And you've done some of this work for us because now we can use ETFs to achieve this. So let's talk about your product, which is HEX, and I think we even have a board where you can walk us through how a covered call strategy works using ETFs.
Sure. I've talked to a lot of investors, I've talked to a lot of professional advisors who find this kind of strategy very cumbersome. It's an administrative and operational burden. So turning it over to an ETF that does it all for you, I think is a wonderful solution, all for 65 basis points. But if you bring that board up, here's our ETF, HEX, and you can see that line looks a lot like the TSX has looked of late. But what you don't see on that board is the fact that we've made a distribution out of that. The call premium is distributed to the investor every single month, and it's averaged about 1 to 1.5% per month of late.
Per month?
Per month. In call premium. Because volatility has been so high, you're going to get more call premium. If we look at how a call option works, if there's another board there where we can show the sort of the payoff profile of a covered call strategy, if you just owned a stock, your payoff profile looks like that gold line. If you instead wrote a call option on a stock you owned, your payoff profile looks like the blue line, where your upside is capped, but a lot of people are okay to cap the upside because they know they're going to get this extra income. And the extra income on this chart is shown with just the gap between the blue line and the orange line. That's the income you're going to get in your pocket. So that's how a covered call strategy works.
So I'm never as worse off once I've written the call. I'm never as worse off even on the downside as I would have been had I just been naked the stock or just been long the stock on its own. And now let's talk about in what kinds of markets this is going to work the best. Because let's be clear, if you own HEX, the market goes down, you're going to have a cushion, but you're still going to go down. So, so let's bring up another chart that we have that kind of shows in different market conditions how we're going to do.
Right. So covered calls, I'd say, work best in what I would call a range-bound market, where I'm getting this premium, but I'm never getting called away. If we're in a powerful bull market, the market's going up dramatically, a covered call strategy will underperform the underlying stocks. Doesn't mean they're going to go down. It just means they're not going to go up as much. You're giving away some upside for that income. In a bear market, you will outperform a basket of stocks. Now, you'll still go down, but you won't go down as much as the basket of stocks has gone down. And so typically, you're going to do better in a covered call strategy in a modest bull market, in a flat or range-bound market, or in a bear market. You're going to do better with a covered call strategy. Where you're going to underperform the market is in a significant bull market. That's when you'll still make money, but just not as much. So I think a lot of people are willing to give that up for that income.
And if it's not a raging bull, we're going to annualize, at least in the way the current volatility would pay us off, somewhere around 15 to 17% a year.
Our HEX, the ETF that was brought up on the board there, its last monthly distribution would annualize out at 17%. Now, a lot of that is because the volatility has been so high, but the premiums being generated because of the current volatility is enormous. And to be able to deliver that to investors in a nice, neat package is fantastic. And we're lowering volatility relative to the market and offsetting some of the downside, which is great. I think it's a wonderful package for investors.
And just quickly here, Ken, with the HEX, you've got the covered call writing in there. What's the underlying assets? The top 30 liquid stocks, right?
What we want to give to investors is we don't want to add value by stock picking. So the underlying basket on HEX is just the 30 largest stocks in Canada. We equal weight them. And that's it. So we're not out there portraying ourselves to be stock pickers in this case. What we do very effectively is a call option overlay. We're very active on the option overlay, and that is where we generate great income. So we're saying, look, we're going to give you the beta or the market for free,
right,
and we're just charging 65 basis points for this option overlay to generate the income.
Very good. Okay, we'll take a short break here. Stay with us. Up next, we'll look at isolating risks using ETFs for both individual investors and hedge funds as well.
David Kaufman is one of Canada's leading experts on alternative investing. He's the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. This week, if you're just tuning in, the topic is how to use options to boost your investments and mitigate downside risk using those options. Joining us again, still with us, is Ken McCord. He's the president of Horizons Exchange Traded Funds. Now, let's talk about some other strategies, some other tools that investors can use whereby you want to hedge out the equity risk entirely, but get premiums from option writing.
Yeah. We've had some really savvy investors out there, both advisors as well as do-it-yourself investors, apply some of these strategies, which have been very, very effective. So I just pointed out in the last segment that you still have some downside exposure with HEX or a covered call strategy. So how do you get rid of that? You could be long a covered call strategy through an ETF like HEX. You buy that, but you could also short the market against that. So by buying an inverse ETF like HIX or shorting something like XIU against it. And so now what I'm doing is simply isolating the call premium. And whatever the market does won't impact my portfolio.
So that's a wash.
It's a wash.
Yeah.
So if the market goes down dramatically, I'll lose on the HEX, but I'll win on my short position on XIU, let's say. But whatever's happening to the market, up or down, I'm completely offset that, but I'm still clipping my coupon. I'm getting the call premiums every month at 1.2% every month. And that way I'm getting that yield that I'm dying for and I can't find anywhere else without a lot of this equity volatility or equity risk.
Right. You mentioned that you could either short the index or you could buy an inverse ETF because, of course, there's an ETF for everything that any investor would ever have an appetite for. Explain the difference about what the advantage would be to shorting versus just buying the inverse.
Sure. So if I had $100 to apply to this strategy, I could put $100 in HEX and get my yield on that. But then if I shorted XIU against it, I'm going to get the yield on my full $100, the 17% yield on the full $100, and eliminate this beta or the market risk. If I wanted to buy an inverse, though, I'd either have to use $200 to put $100 in HEX and $100 in HIX, or where I get the full yield, or I could put $50 in HEX and $50 in HIX. But what that would do would cut my yield in half on my $100.
And so,
I'd be making sort of 8% on my 100.
So because I've neutralized that equity risk with the two of them, I'm never going to get a margin call, so I might as well use the margin if it's available. So
exactly, yeah, that's a good point.
Is this the perfect investment? I mean, how is it possible to lose money using that strategy?
Well, I think I don't want to call it riskless, of course, because the challenge would be if volatility dries up and goes down dramatically. I mean, there's a cost to ETFs, there's a cost to products, there's a cost to hedging, there's a cost to shorting. And should volatility dry up and the monthly premium I generate doesn't exceed some of those costs, then I'm not going to generate that kind of what I would call risk or beta-less yield. For the most part right now, if you're a nervous investor, you're worried about volatility, I think that's a great trade. It's a trade that I think a lot of hedge fund managers have put on, and now this allows the retail investor, the do-it-yourself investor, to put that trade on very, very easily with ETFs.
And just to be clear, so what we're basically doing is we're sort of clipping the coupon, so to speak, but we're giving up the dividends that come from holding that long basket of equities by shorting the same basket at the same time.
That's right.
So we're getting very pure about how it is that we're deriving this yield from our portfolio.
Yeah, because some of the yield I'm delivering you through HEX, most of it's covered call, most of it's call premium, some of it's dividend. If I short XIU, I'm going to basically be having to pay back that dividend. So you're right, you're isolating the call premium if I do that strategy.
Ken, you mentioned hedge funds there. Some investors may know that hedge funds use ETFs a lot.
Yeah.
Others may not. What are some of the strategies that they do use?
Well, hedge funds right now are doing a lot of things with certainly in the commodity area, rather than use future contracts, which can be very difficult and costly, and you need margin on those things. A lot of them are using ETFs to execute a strategy on commodities. I mean, if you remember on Wednesday when gold was down $100 an ounce, a lot of investors would have bought HBD. A lot of hedge funds bought HBD, which gives you a long position in the inverse exposure to bullion. And rather than occupy some of the short selling space in their fund, they were able to take a long position in an inverse strategy, to execute that vision. And so we're getting a lot of pickup in our ETFs from hedge funds that want to execute a strategy very quickly and efficiently through the exchange.
I love this because we talk a lot about some relatively complex and illiquid strategies that are available only to institutions or high net worth investors. But really, this is the democratization of investing because they're not getting any special deals. If they go and buy GLD or whatever it is to buy gold, they're paying exactly what I'm paying. Is that right?
They are paying the same rate that you and I are paying, whether they buy GLD or HEX or whatever. Yeah.
And can you talk about the idea about buying cheap beta and what the difference is between the beta and then the alpha, of course, that they better deliver if they want to collect those enormous fees?
Yeah, I think that's a great point because there's been this notion in the institutional world for some time is don't pay for beta, don't pay for what the market delivers. So it's been tough for the retail investor to really do that or execute that. We've got an ETF HXT, which is 7 basis points to give you exposure to the TSX 60. It doesn't get much cheaper than 7 basis points. And that allows you to get your beta almost for free, 7 basis points. And that allows investors to do their own strategies on top of that, and whether it's sell calls or add some commodity exposure to that position through ETFs. To deliver strategies that a lot of hedge fund strategies have been charging 2 and 20 for the last 20 years, right? Now I can do it through my discount account very cheaply.
From home, if you want.
In your jammies.
In your jammies, yeah, there you go. Just to wrap it up, I guess we should highlight the risk of some of the Horizons products and leverage products in general. You mentioned HBD.
Yeah.
Investors should know that it's leveraged and that it could turn against you pretty quickly.
Yeah, what they should know is that really the obligation of those leveraged ETFs is that they deliver double the exposure for that day. And for that day only. Right. So they need to know they're going to get double the return for that day. Weird things can happen in periods of high volatility and longer time horizons. You may get way more than double or way less than double. So they need to just know what the ETF is designed to deliver, and it has done exactly that. But they do have to keep an eye on that stuff for sure.
No.
Any final thoughts?
Just one final thing. A lot of us have cash at home. The latest news is that we have to pay the bank to hold our cash for us. Very briefly, what options can you give me to get something out of my cash?
Yeah, one of the things we like is the Australian dollar. The Australian Treasury bills, for example, are yielding you 4% right now. And there's a high correlation between the Canadian dollar and the Aussie dollar. It's over 95%. So rather than buy Canadian T-bills that yields you nothing, why don't I buy some Australian Treasury bills that are yielding me 4%? Well, how do I do that? Well, we just happen to have an ETF that does that. Ticker symbol ASD, which just is giving you exposure to Australian dollar cash. And that gives you a 4% yield with very little risk.
Thanks for coming in today, Ken, and running us through all those strategies.
Pleasure, Mark. Thank you, David.
Great stuff. All right, thanks, David. We will see you next week. That's all the time we have for today's show. We'll see you on Alternative Investing next week.